many of you. And again, thanks for taking a few minutes today to spend and inviting me anyway. So what we're going to talk about today is not options. It's actually an investor's guide to beating a benchmark, and Matt kind of clarified the difference of a trader and investor pretty darn well. And this topic is actually, believe it or not, controversial in that most of the financial advisors out in the world and money managers don't believe it can be done. Basically, beating a benchmark is outperforming the market, and we'll talk more about that. And I'll be honest, no one knows, and we don't know at IronGate Global from year to year whether we're going to outperform the benchmark, but there's three things that we'll share with you today that give you a pretty good chance to outperforming that benchmark or the market as a whole. But before we get into those three things, of course, disclosures. Now that our firm is managing right around 130 million, these are becoming more and more important for us. Please understand that past performance does not guarantee future results, and you can see the rest of those disclosures right there. So the content, by the way, that I have created is based on 15 plus years in the industry, as well as managing money before and with IronGate Global and working with clients and many individuals over the years. So here's the three things that we're going to learn about on how to beat a benchmark. And I've got my chat window up, just so you know. If you have any questions, as long as the chat function works, I'll be able to see those and refer to those as we go along. But first thing we'll talk about today is risk-reward, the importance of risk-reward. Then we'll talk about investment style, and something that's again, kind of controversial, especially this week in terms of investment style. And then we'll talk about allocation, which is critical. But let's do number one first, which is risk-reward. So risk-reward, and let's start with risk. Risk defined, and this is how we define it, just so everybody knows. We define risk at IronGate Global Advisors as the permanent loss of capital. So when you make an investment, what is the risk that you're going to lose that investment? That's how we determine risk. However, most people in the industry define risk as volatility. The ups and downs in the portfolio drawdown. How much money do you lose in a given, not lose, but how much money does your account lose in value for a given period of time? That's volatility. And on the upside as well. So it's the swings in the market. It's the swings in your portfolio. That's how most people define it. That's how that's what we'll discuss today, is that volatility in terms of risk. And here's something that you need to understand right out of the gate. The volatility is the price you pay for future returns. The less volatile your portfolio, the smaller returns. The greater volatility, the greater potential returns. And again, I'll show you some examples of that. Now, in terms of risk, what we do is we take clients, potential clients, or just friends for that matter, through an assessment. And that assessment, there's three steps to it. The first step of that assessment is assigning people what we call a personal risk number. So we'll have people log online and answer some questions. It's based on Amos and Tversky's Nobel Prize-winning studies on psychology, market psychology, behavioral psychology. And they answer these questions, and they're assigned a personal risk number. That personal risk number, as it's assigned to them, they come up with it themselves. We then have the conversation, and part of that conversation with them is understanding the volatility that comes with that personal risk number. Example, this is a risk of 55. So this person is comfortable with, in a 6-month time frame, being potentially down 11% on $1 million portfolio, losing 100, not losing, but being down 100 and almost 10,000 to being up 171,000. And so that's what the volatility of a 55 would be. So if we look at that, step one, identifying your personal risk number. Step two is what we try to do at IronGate Global is we build a portfolio around this 55 personal risk number. So it matches the individual's risk tolerance. And I'm going to explain why that's important here in just 1 second. So that's step two, building the portfolio to match the individual, not putting them in some cookie-cutter portfolio. The third thing, which is arguably the most important, is to ensure that the risk that we're taking with the potential reward gives them the retirement probability, call it goals probability, whatever those goals may be, to accomplish what they're trying to accomplish. And so that's the 3 steps that we take people through. Now, here's the problem that we run into. And I would say, by and large, we run into it more with educated investors than non-educated. And that's an interesting thing. You would think the more educated someone is, the more realistic they would be, and the more, I don't want to say knowledgeable, but I'm going to say it anyway, knowledgeable they should be. But here's the problem that I'm talking about, and that is people come to us and they say, okay, I've got a personal risk number of 55. I want you to outperform the stock market, and this is the risk I want to take. And maybe it's a husband and wife, right? It could be a husband and wife. The husband's a 55, the wife's a 75 or 90 or whatever, and they don't come to the conclusion or they don't decide together what that risk is, but they come to us anyway, and they say, you know what, I've got a personal risk of 55. I want you to outperform the market. My immediate response to them is, can't be done. It cannot be done, because you need to understand, in terms of risk, the stock market risk using the same scale is a 78. So if we're going to risk 55 to outperform the stock market, and we're not taking enough risk to outperform the stock market, we're not going to outperform the stock market. And this is probably one of the biggest hurdles that people go through. And I'd say more educated people. They don't want the volatility, but they want the returns, and simply that cannot happen. And so the solution is this for anybody. If you want to outperform the market, you just have to take greater risk than the stock market in terms of volatility. So if the stock market, the S&P 500, has a risk of 78, your personal risk number is an 85. Okay, let's do it. Let's try to outperform the market. You can see the volatility scale on that risk of 85, down 20% to up 30%. So compared to the left-hand side, which is down 18 to up 26%. So the bottom line is, and husband and wives need to come together, and certainly advisor and client, or just the client himself, if they're just managing him or her money, they need to understand, if my goal is to outperform the market, I need to take the equivalent risk to do so. That's huge, and that's the first key, and that's the key point. You must be willing to accept greater volatility than the S&P 500. Now, I would also add to this, and this is a whole other conversation, and in another 2-hour discussion, which I'm not going to get into. Look at the key point for a second at the bottom of that slide. It says you must be willing to accept greater volatility than the S&P 500. That does not mean that, in our terms of risk, that you're going to lose more than the market. It just means your portfolio is going to be more volatile than the market. Remember, volatility is not permanent risk. Permanent loss of capital. They're completely two different things. So the volatility, you've got to stomach it, bottom line. Okay? So that's the first thing that you need to understand from a risk-reward standpoint, is you got to take more risk in terms of volatility than the stock market. So that's the first thing. risk reward. And it's easier said than done for most people. We've actually had, what I just shared with you, over the last 3 years, there's been, I don't know, probably 5 clients who have struggled with that, almost all of them from the Invest Tools world that have struggled with that notion. And so right out of the gate, you've got to understand the importance of taking more volatility than the stock market. All right? So, next thing, investment style. And this is also kind of controversial. Just this week, in fact, and our newsletter just pointed this out if you subscribe to it. If you don't, then do. But it said this. This is a report from J.P. Morgan. And this blows my dang mind. It says just 10%, and this is summarizing, right? Just 10% of trading is regular stock picking, J.P. Morgan estimates. Look at that, the first kind of bullet in highlighted in yellow. They say fundamental discretionary traders account for only 10% of trading volume today. That's insane. The second one, the majority of equity investors today don't buy or sell stocks based on specific fundamentals, which again, to me, is absolutely crazy. Matt talked about it. He said fundamentals matter. I completely agree with Matt. And here's a couple things that you need to understand. Why are so few people doing old-fashioned fundamental analysis these days? Well, it comes down to 2 things. Number one, it's hard work. People aren't willing to put in the work. And 2, along with the work, is it costs money. Right? Those hours and hours of studying these individual stocks, it costs money. And so hard work and the fact that it costs money and the fact that the indexing via ETFs or mutual fund is so popular right now, stock picking the traditional way is really kind of diminishing. And what we believe is that's great news. That's great news for us. We never want to be part of the herd. We like being part of that 10%. Iron Gate is in that 10%. We are fundamental value investors a la Warren Buffett. Although we'll never claim to be as good as Warren Buffett, that's how we invest. And we're happy to be in the minority. We're contrarian investors, and this report was actually good news for us, but shocking nonetheless. And so how do we invest via value investing? We do 4 things. And this is really, again, this is a 2-hour discussion by itself. I'm going to briefly discuss these 4 things, which are 4 principles. And if you have any questions, we can jump on the phone at another time and I can describe it a little bit more. But the first thing is we only invest in industries and companies we understand and frankly that we like. Right? Matt mentioned retail. We're not investing in retail sector right now because we don't like it. We do understand it, but we don't like it. But there's a lot of other sectors that we just don't understand. How in the world? I mean, most of these technology companies, how in the world do they work? It changes from one week to the next, and so keeping up with that's very difficult. So we only invest in those areas of the market that we truly understand. The second thing that we always look for in a stock is it's got to have a competitive advantage. Warren Buffett calls that a moat. It's got to, it would be great to invest in a company that is, think of Amazon. What a huge competitive advantage they have right now. Think of Google, their competitive advantage in what they do. And you can think of these companies, Disney, for example, huge competitive advantage in many ways. And so we definitely look for those companies that have that competitive advantage, and we look for companies that have good management. Now, why do people, why are we looking for good managers, and how do we do that? Well, we look at the track record of a given CEO and their management. We read shareholder letters. We get an idea for how that CEO treat shareholders and how realistic they are. We don't really love the rah types. We love the, hey, here's the truth types. And so we look for those types of managers. And that takes time. And that goes back to that J.P. Morgan report. There's just 10% of trading is regular stock picking. Because those three things are hard to come up with. And arguably this fourth one is probably the most difficult, which is we want to find companies that are trading at an attractive price below intrinsic value. And that's coming up with a valuation for a particular company. What do we feel it's worth? You know, it's not black and white. There is some discretion there. We're conservative in our approach, and it takes hours and hours to come up with. I would say by the time everything's said and done, for every stock that we're in, that we've purchased for clients, we probably spend over 100 hours studying them. Yeah, that's hard work, and that's why people have a hard time doing it. But I would also add that's what's allowed us to create the track record that we've created, which I won't. If you want, you can email me and I'll send you our track record. But if you have any questions, by the way, I don't know if the chat's working or not, but chat them in. More than happy to discuss it. So that's the second, the second thing that we'll discuss, risk reward, and we covered that. And then what type of investments do we invest in? And we covered that, which is value investing. Now I'll come to the third piece of the pie, which is also a little different than most people, and that is portfolio allocation. Now, I've reviewed hundreds of portfolios for people, and I've got two examples that are real client portfolios. I've removed the names of the individuals, and I'm not going to tell you who their portfolio managers are. I know all of you know who these people are if I said their names, but I'm not going to throw anybody under the bus here. But these are two typical real client portfolios that we see. Here's the first one. This is a list of the amount of money and the allocations that a portfolio that we reviewed had. Right? So you had all of these investments in the same portfolio. And that's not even all of them. Here's more. So in this particular portfolio, and you can look at this for just a second. You have positions of 0.8%, 0.9%, 0.5%, 0.5%, right? You have 51 different holdings in this portfolio, and when we ran the report for this individual, the expense ratio, which is how much does this portfolio cost to own the underlyings that it does, the holdings that it does, it's 0.12%. So for 51 different underlyings or holdings, stocks, some ETFs, a few funds here and there, 0.12%. And I'll mention why we don't agree with this in a second. That's the first one. The second one, portfolio, typical.
Can I break in? How do you calculate the expense ratio?
The expense ratio, yeah, that is not any advisor fee or anything like that, right? It is, if I own these ETFs in my portfolio or mutual funds, at the allocations that they are, say 5% or 3%, then compared to the rest of the portfolio, how much is that costing me? So that's the expense ratio. So on the portfolio as a whole, say it was a $1 million portfolio, you're paying 0.12% annually just to hold the investments you're holding. So that's how that expense ratio is done and figured out. So a client can or a potential client or just a friend can easily say, okay, what's my portfolio value? What's 0.12% of that portfolio? That's the fee I'm being charged just by owning the funds that I'm owning. And 0.12%, by the way, that's not bad. I've seen a lot worse. Certainly I'd like it a little lower than that, but that's not bad. So, good question. Good question. Here's the other portfolio. So just to recap, that's a typical portfolio I probably see once a week, sometimes more. The other type of portfolio that we see has very few holdings. You can see there's only 12 total holdings here. But whomever built the portfolio, built it with mostly mutual funds, some ETFs, and you can see the expense ratio on that portfolio, which was crazy, 1.18%. And when you share this with people, they're shocked. How in the world can I have a portfolio to 1.18%? So that's another example, but you can see how these are completely different. 151 holdings, 112 total holdings. So there's a couple other questions too that came in, and I'll address those now while we're on the topic. Helen, how big is this portfolio and what are their needs? Like, is it for retirement? Yes. So that's the thing is we'll get portfolios that have different goals attached to them. Some are retirement, some are college savings, some are I want a house, some I just want to make money, frankly. And so you're going to have all sorts of different goals. This one, Helen, is for retirement, but that doesn't mean, see, here's the thing that you've got to get in your head, folks, is even if a portfolio is retirement based, I want to invest for retirement, that in and of itself shouldn't dictate the risk that you're taking. That's a personal thing. The risk that you take is a personal thing. And some people have to take more risk than others. And some people shouldn't take a lot of risk. But the risk is different than, it's completely up to the individual what risk we take. Next question, how do you accomplish number 4 in a market that say most stocks are extended or overvalued? Yes, great question. And you're talking, John, go Tigers, okay, whatever, dude. But hey, that's going back to the 4 principles of investing in stocks. And I'll tell you, John, looking for stocks that are undervalued in a market that we believe is fair valued becomes very difficult. And it just means more work on our end. They're out there. We have a few on our list. We have a few in our portfolio, in fact, that we'd still buy. But it just takes more work, bottom line. So good questions. So the 2 different types of portfolios, one has more holdings than the other. Expense ratios, certainly they matter. But I want to focus on this portfolio A for a second, which had all of these different underlyings, 51. And I want to bring up, you can see Warren Buffett has a quote on diversification that we as a firm really love. He says this, he says, if you can identify 6 wonderful businesses, that is all the diversification you need, and you will make a lot of money. And this is Warren Buffett speaking here, right? So he also says, and I can guarantee that going into a 7th one, and this is one of my favorite parts of the quote, instead of putting more money into your first one, has got to be a terrible mistake. Very few people have gotten rich on their 7th best idea. I'll repeat that sentence. Very few people have gotten rich on their 7th best idea, but a lot of people have gotten rich on their best idea. So I would say for anyone working with normal capital, which I'll define in a second, who really knows the businesses they have gone to, 6 is plenty. I don't diversify personally, says Warren Buffett. So let's dissect this for a second. Number 1, he says if you can identify 6 wonderful businesses, right? And then he says, why in the world would you add a 7th stock if it's your 7th best idea rather than just putting more money in your first idea, which we wholeheartedly agree with. And then he goes and talks about for anyone working with normal capital who really knows the businesses they have gone into. And we'll identify normal capital in just a moment. But one of the key parts of what he's saying here, who really knows the businesses they have gone into. I can, certainly the businesses that we buy, we really know the business. In fact, we take a kind of a private equity approach to understanding the business through our research. We're not just out buying stocks because a cup and handle formation or an inverse head and shoulders bottom formation, but we truly understand the market and the businesses. We truly understand those businesses, and that's rare. And again, that's hard work. And again, that's why only 10% of the people in the world today are doing it. All right, so let's identify normal capital. One of the problems with people in some investment management companies is when they become too big, managing billions and billions and billions of dollars for their clients. Not even five, I would say more like 25, 30, 50, 70 billion dollars, it becomes very, very hard for that type of firm to put more money in their top idea and only have 6 stocks. So if you have an investment management company that's managing billions of dollars, they're forced to diversify with 50, 60, 70. I had one portfolio where there was 83 holdings in that portfolio. You know, to me, if I have 83 holdings, just buy the VOO and call it good. You're basically tracking the S&P 500. That's what normal capital means. But here's the thing with Warren Buffett. I'm going to show you what our portfolio looks like and discuss more on this quote. It's this. It's an aggressive portfolio for Iron Gate Global. You can see that I've blotted out our holdings. That's not fair. If I share those holdings, that's not fair to our clients, and that's also to our compliance. So I'm not going to focus on any ticker symbols today, but I am going to focus on a few very important things that you can learn. And here's the first one. In this portfolio, there's 11 holdings. We have 10 stocks and 1 ETF. The ETF's a global ETF. It's the best way to take advantage of a certain area of the globe, which is why we have an expense ratio down at the bottom of 0.04%. Very low expense ratio. That's that one ETF. You can see the risk for an aggressive portfolio is 87. The volatility associated with that risk number is below. Minus 21%, up 31.9%. You can see this is an actual portfolio. They've got $486,000 invested in an 87. If someone can't stomach that 87 risk, we will not put them in it. But if they cannot stomach an 87 risk, then the potential to outperform the benchmark or the S&P 500 is very limited. Right, so 11 holdings, 10 stocks, 1 ETFs. Now, pay attention to the column I just highlighted. At the very top, you'll see 16.8%. Then you'll see 12.6%. That's the allocation that we have, and those are individual stocks, so you know. But those are the allocations that we have to individual companies. So when Warren Buffett says, why not put more money into your first best idea? We agree. 16.8%, 12.6%, down to 11.6%. So we overweight the portfolios. They're more concentrated. We overweight them to those ideas that we like the most. That's how we build that portfolio that has an opportunity to outperform the given benchmark. Now, there's a question that I always get from clients that I'll anticipate, from you, and that is, how do you determine how much to allocate? Why would we go 16.8%, 12.6%, 11.6%, so on down the line? Yeah, it comes down to a couple important things. Number one is risk-reward for the given ticker and risk-reward for the portfolio. When I say risk-reward for the ticker, for the stock, what I mean by that is how good of a value are we buying it at this current price? So it's based on value, but it's not just based on value, because there's a lot of stocks that are trading at a great value that their companies stink. Their businesses stink. So it's not just value, but it's based on, okay, what can we buy it at and what's the potential reward? Obviously, we really like that company at 16.8%. We really like that company at 12.6%. We call it our conviction level. When we're in our investment committee meetings, Brian and I, my partner and I, and then our other colleagues, we always say, how confident are you in this investment? And if it does not work, what's the risk? And once a week we have those discussions, and then we adjust accordingly. But that's an aggressive portfolio that we would build. That does not include options. We do options, but I'm not going to talk about that right now. And it also depends on the market as well as to when we do options. So I saw a couple of, I think there are more comments than questions here. If you're diversified in large companies, don't you need to increase your diversification just by how these companies are internally versus a very focused entity? I'm not sure I understand that question, John, if you want to elaborate. Or maybe it's just a comment. So, but that would be an aggressive portfolio. Hopefully that makes sense to everybody. If it doesn't, please let us know. Please let me know. Type in some questions if you have any. The last thing I'll say is a comment that Matt had that actually scares me quite a bit, because more people don't know this than know it, and that is the risk in a given portfolio. He talked about being ignorant of the risk, and I would say most people don't understand the risk that you have in a portfolio. So if we can help you do that, if all you want to do is say, hey, Brett, help me identify the risk in my portfolio, let me know. More than happy to do it. We do have certainly a free, and I'm not a salesman. I'm not going to sell you on anything, but we do have a free risk analysis, 4 steps, helps you understand your personal risk number, helps you understand your current portfolio risk. What's the probability of accomplishing your goals based on your current portfolio? And then how would a change in the portfolio change the probability of accomplishing your goals? And it's fascinating, and we take people through it, and it's mind-opening, and it shares a lot of other information, as far as expense ratios and risk in the portfolio, and we stress test things. And if all it does is give you more clarity on your portfolio, then we've accomplished our goals. So with that, I'll wrap up. There's what we were going to discuss. There's what I believe we've accomplished. Certainly ask any questions if you have them. Here's our phrase at Iron Gate: relax. We can take it from here, my friends. There's my contact information as well. If you have any questions, comments, feel free. Now I saw a question from Helen. What is the risk level that just matches buying the SPY? That's 78, Helen. It's a good question. In the risk software that we have, it is a 78. So in terms of outperforming the market, you have to be taking a 79 or higher. The higher, the more volatility, but the better chance you have at outperforming the market. So hopefully that answers your question. John, no problem. I like it. All right, my friends. Britta, I'll throw it back to you.
Thank you very much. Any questions for Brett? So Helen says, since 80% of the stock trading is institutional, are you saying that the institutions don't do much fundamental analysis, or is that just the 10% of the retail traders?
Good question, Helen. No, that is taking into consideration institutional trading. And yes, I'm saying that institutions don't do much Think of all, in fact, think, Helen, and everybody else, of all the portfolio managers you have, and many, including many advisors that you guys use. Think about how they invest. They're indexers. They may overweight an area of the market or two. Maybe they're global, but by and large, they're using ETFs. Very few go in and stock pick, and if they do stock pick, they're buying 50, 60, 70 stocks, basically recreating the S&P 500. So that J.P. Morgan report is taking into consideration not just retail, but institutional as well, which is sad, isn't it? It really is a sad report, but true to the true to the environment we're in. So they wouldn't. Yeah, good point, Helen. Helen says they wouldn't admit to that, would they? No, they wouldn't. But if you're around the industry as much as I am, and I'm talking about advisors and money managers, I will tell you that think about the cost of running a portfolio management company, and I know this pretty darn well because we run one, and that is the cost for doing fundamental research and spending the hours to do so is great. My partner, in fact, who's our lead fundamental value investor, Brian, that's 80% of his time is studying stocks. Now think about the time that we could save as a firm if we said, Brian, don't spend 80% of your time researching stocks, and then mine would be about 15% of my time. Let's just do ETFs, and then let's just go market and try to sell our firm. And that opens up the schedule to try to grow the firm. And that's how things are being run right now. We're never going to go that path. If we do, then I have failed, and anyone that was my client could fire me. We will always be fundamental analysts and take advantage of those volatile at times in the market, like we experienced, this last week with the tech. So yeah, Helen, it is. They wouldn't admit to it, but you can think about the portfolios you may have and how they're built, and it's pretty easy to see. So, good question and comment. All right, and by the way, if you want us to, we can even do this. We don't even have to talk on the phone if you don't want, but if you want to find out what the risk-expense ratio, what the stress tests look like within a given portfolio that you have, even your own, just email me and say, I want a risk assessment in the subject line, and I'll shoot over a link. And you can do it all on your own, or we can jump on the phone for 10 minutes and I can lead you through it. But, the more people that have an understanding of how their portfolio is built from a risk perspective, in my mind, the better, certainly. So feel free to pop me an email. More than happy to help that way.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.